On your screen, you see the mountain ski shop page from the General Journal. And a week or so ago, you had, or I gave you another video using this company, and we looked at payroll entries. You've done that a few times now. On your screen, you see a typical payroll entry, and we're going to now take this a step further and see what happens after the first quarter of the year. So let's take a look at what we have here. First of all, we will assume, as we did in the previous video, that the mountain ski shop pays its employees monthly. So what you see here happens to be information at the end of March. So in the previous video, I think we talked about the same business at the end of January. Now we're even further into the future. We are at the end of March. So at the right-hand side, you see that this is the monthly payroll information for this month. And we see it journalized in the General Journal there, based on the same information we had previously. Gross monthly salaries, we will assume it to be the same just to make things simple. So the total amount earned by the employees is $24,000. They don't get that, as you know by now. They get net pay because they have several deductions, money that we withhold from their paychecks. For example, we have federal income tax. We withheld $6,000. And again, I'm giving you the numbers, and we're not going to worry about how those numbers are computed, but we will look at that much later. So for federal income tax, we withheld $6,000. For state income tax, for the employees, we withheld from their paychecks $4,500, and FICA tax was withheld as well. FICA, as you should know by now, consists of deductions for Social Security and for Medicare, totaling $2,000. So these are the deductions, and you see them journalized over on the left. Salary expense, as all expenses would be debited by the total amount, the gross pay of $24,000, and you've got three liabilities credited. Hopefully by now, you know that when liabilities are increased, the increases are shown on the credit side. And indeed, they are increased because we are going to be owing more money. It's the money earned by the employees, but we've taken it out, we hold it for them, and later on we're going to be paying on their behalf. So those liabilities increase, and each one is credited, as you see there, and you should know by now that when you add up these three liabilities and subtract from the debit, the $24,000, you'll get $11,500. That's how you compute the net pay. That's what they actually get. So, as always, all the credits need to add up to the same as the debit. So if you add up those four on the credit side, they will add up to $24,000. So debits equal credits. And we are paying them with payroll checks. These are not the normal checks that we use in our company to buy things such as material and supplies and so on. But these are separate payroll checks. But the money comes from cash, the cash account. So that's why cash goes down, it's credited. So all of that is something you should understand by now. And we're going to look at the ledger for just a moment to see how this ended up being posted. So salary expense is debited by $24,000. If we go to the expenses, find salary expense, you see that indeed on March 31st, it's already been journalized and posted. So there's a debit of $24,000. As I said several times now, the revenue account, normally sales, and all the expense accounts end up at the end of each accounting period with a zero balance. And don't worry about why that is at this point. We'll explain that a little later. It has to do with the fact that these are the things that end up on income statements, which show information for one particular accounting period. So for this accounting period, which happens to be a month long, salaries would show $24,000. So the previous months of January and February, we would have done the same thing. We would have debited salaries expense, but somehow this account ends up with a zero balance. So don't worry about how that happens and why. We will explain later. At this point, though, just take a look at the debit of 24,000. Where did we get it? We got it from the journal, and so we take the account number 504, and it's back into the journal. And all of these are now credited. Now let's take a look at those. Let's go to federal income tax payable. It's a liability. We find it under liability tab at the bottom. So federal income tax payable account is a liability account, and it has now 3 credits. These accounts are different than expenses. They don't end up with 0 balances. They carry over. So in January, at the end of the month of January, we had a payroll entry just as we saw in the journal, same kind of thing. And we credited $6,000 to that federal income tax payable account. We didn't pay it yet, so it's still there. Same way in February, another payroll entry, again another credit of $6,000. And now in March, we just saw that in the journal on March 31st, there was a federal income tax payable credited by, again, $6,000. So we have money that we have taken out of employees' paychecks each month totaling $18,000. And we'll come back to that in a few moments. But this is what we owe because we kept that money out of the employees' paychecks. We have to pay it sometime on their behalf. Same thing happens in the state income tax payable at the end of January, at the end of February, at the end of March. Part of those payroll entries would have been credited to that state income tax payable account of $4,500 each month, always the same in this particular business. And now we owe, because we have to pay on the employee's behalf, we owe $13,500, and we have to pay it to the state. FICA tax payable, we see 3 credits at the end of January, February, and March of 2000, adding up to a total of 6,000. Excuse me. And that's currently what we owe for FICA. There's a little bit of a wrinkle to this that I'll explain in a few minutes. But this, in the liability section of the ledger, will show those accounts that deal with taxes that we withhold from employees. So we have now posted all of these accounts in the ledger, and we have also posted cash. So if we go to cash, we see on March 31st a credit of $11,500. So the cash account goes down a little bit. One other point with this, the original balance of $67,221.50 would have included a lot of debits and credits from a lot of different transactions, including the payroll entries from both January and February. I didn't show them all here, but they would all be contained and ended up in this account with this debit balance that you see there. So now when we do March, as of March 30th, we had $67,221.50. Now, the next day, we're going to have a credit of $11,500. And again, the 101 goes back into the journal. Now, the reason I'm using March as the month here is because that's the 3rd month of the year, which is the end of the first quarter of the year. So this little transaction has to be handled at this point. At the end of March, not only do we have to do the payroll entry that we just looked at, but we also now have to pay because we're at the end of the first quarter. The first quarter payroll taxes are due, and we have to pay all of these amounts. Okay, so we'll take a look at how this works. Let's do one of them here. This is at the end of March, and we're going to pay, we'll take these in order. We're going to pay the payroll taxes, first starting with the federal income tax. But we don't use that amount. We have to find out how much we owe. We're going to pay the federal income tax payable account. And when we pay a liability, we are reducing it. So that's why we're going to debit this amount. And we need an amount here to put in. But as I said, we don't use the 6,000. We have to go to the liability account and look at how much we owe. Federal income tax payable, we look at the balance at the bottom. We owe 18,000. That's what we have to pay. So that's what goes over here. And we're paying with cash. Anytime it says pay, you can assume it's going to involve cash. 18,000 is credited to cash because it goes down. So let's assume this is check number 901, and that's the information at the bottom. So let's post this. This goes, as the journal says, to this account debited. So we go to federal income tax payable, the date, and it is J17, journal page 17, and it was debited, right, from the journal, 18,000. So we debit here, and if we did it right, we should now owe 0 because we just paid this liability account. Account 202, back into the journal, and we have to credit cash. We're paying money. Go to cash, the date, the journal page, and a credit of 18,000. We're paying more money. Cash balance goes down again. 101, back into the journal. Let's do another one. Same date, end of the quarter. And now we're going to pay the state income tax. And we're going to debit the account, same as we did with the federal income tax. And we need to find out the amount that we use. And once again, don't look up here because that's not going to be the amount we need. So we need to pay the total amount, go to the liability account, check it out in the ledger, and we see that under the state income tax payable, we owe $13,500. That's what gets debited. And once again, our cash account gets credited by the same amount. That's what we're spending. Whoops, that's not what we're spending. $13,500. And this would be check number 902. Has to be a different check because the first one went to the federal government. This goes to the state government. So let's post this. The 13,500 is a debit to state. Journal page 17. And it's a debit. 13,500, which gives us a balance of 0. Account number 203, back into the journal, and again cash gets credited. Same date, same journal page, and cash is credited. So we're reducing our cash here. We better make some more sales next month. So account 101 back into the journal, and that has been posted. Okay, so it becomes repetitious after a while. It's not that difficult, but as I said earlier, this is always contingent on knowing debits and credits and increases and decreases sides of accounts, and all of that becomes very important because you need to know how to journalize properly in order to post properly. One thing we're not going to do here is FICA, and there's a reason for that, and it has to do with the fact, if you remember when we introduced these tax liabilities, FICA is the one that is split between employer and employee. If we look at FICA tax payable, this $6,000 represents the amount we withheld from employees, but we have to pay our share as well, meaning the business. So we're not quite ready for that. We'll explain that in a few days. So we're going to hold off on paying FICA at this point. So review this video if you need to, and at this point I'll ask you to go back to your course page. There's a problem that will give you some practice with all of this.